Good morning, everyone, and thanks very much for joining us. And it's great to see so many participants for this webinar. I'm Jeanette Weldon. I'm the Executive Director of CHEFA. And one of the ways that we try to provide value to you, our clients, is through our post-issuance compliance services. And tax compliance in particular can be somewhat of a daunting task given the complexities of the IRS code and also actually the current interest rate environment. So this morning we have three experts who will explain it all for you in very straightforward and clear terms. We have Keisha Palmer, who is a partner at Robinson & Cole. Dave Panico, also a partner at Robinson & Cole, and Robinson & Cole is one of CHEFA's longstanding bond counsel firms. And we also have Dan Kurowski, CHEFA's manager of program development and CHEFA Community Development Corp. And Dan is the person who has been doing your calculations with regard to post-issuance tax compliance and also doing a lot of monitoring to make sure that you are in sync with all of the requirements. So we have structured this to incorporate some time for Q&A, and so that will be following the presentations. But what you can do is at any point, feel free to put a question into the chat and it will be monitored and then be brought forth at the end of the session. And then also the other option is you can use your raising of your hand on the reactions in the toolbar if you want to actually ask your question at the end of the presentation. So with that, I will turn it over to Keisha.
Thank you, Jeanette. Good morning, everyone. After 3 years of the pandemic, I'm still not unmuting myself on time. So this morning, we are going to jump right into our presentation. And we have a robust presentation for you this morning. We hope that you have some good questions and we're going to cover some good examples for you. We're going to start off with some of the basics, which I think most of you know the basics of tax exemptions. So we will just whiz through those and then we'll get a little more detailed when we get to a little some more of the more complicated issues. So Section 103 of the Internal Revenue Code provides that gross income does not include the interest earned on any state or local bonds, which then make them a valuable investment for people looking to diversify their portfolio and to avoid paying too much in taxes. A state or local bond, as you know, is an obligation of a state or political subdivision or any on behalf of issuers, which includes constituted authorities such as CHEFA. There are two significant effects to the tax exemption. It reduces two significant benefits to issuers of these types of bonds. It reduces the effective interest rate on the obligation, and then while that's a benefit to you, the IRS sees it as a negative to them because it denies tax revenue to the federal government, which is why it's always described as a second benefit to you. Whenever the IRS gives any benefit, such as a tax exemption, it's generally limited and subject to many rules and regulations, which I think we've all come to know by now. It does not apply to what we'll explain later, but what we typically call private activity bonds, which are not qualified bonds, and it doesn't apply to arbitrage bonds, which Dan is going to get into in a little while. So we'll cover the private activity bonds and qualified bonds exception. Dan will cover the exception for our bonds, and the joint panel will discuss post-issuance compliance, and then we'll all take your questions, as Jeanette mentioned. So let's move on from the basics and start talking about private activity bonds. So typically the tax exemption given by Section 103 is provided to local governments, to state and local governments to finance their capital needs. And those are the things that you can think of, right? So schools, roads, water distribution and treatment plants, and those kinds of things. Anything that from an accounting standpoint would be sort of a capitalizable asset. Typically, they would be able to use tax-exempt bonds proceeds to purchase or to build. This is not intended to benefit private users such as trades or businesses, and surprisingly, nonprofits sometimes fall into that category, as does the federal government, which always surprises a lot of people. Typically, only about 10% of your tax-exempt proceeds can be used by private users, and use is whether they're using the actual proceeds or they're using the assets purchased by the proceeds. But while private activity bonds are bad, the IRS recognizes that there are some trades or businesses that serve the public good, and they should be eligible to use tax-exempt bonds. They should get some of the benefits. And so they give us a few exceptions. And typically those are the qualified bonds. And we're going to talk about in depth the 501c3 bonds. But a few of the others include the exempt facilities bonds, which typically use to finance airports, docks, affordable housing, electrical facilities. There is an exemption for small issue bonds for manufacturing facilities, and then student loan bonds. And of course, as I mentioned, our favorite 501c3 bonds. So one important thing to remember, as I said before, whenever the IRS gives us any benefits, it comes with rules. And one of the important rules is that the tax exemption does not apply to private activity bonds if they're not qualified bonds. And if your qualified bond, you could lose your tax exemption. You could have your bonds become non-qualified bonds if you don't follow all of the rules. In particular, we're going to talk about the 501c3 bonds, which can be qualified bonds as long as you follow the special rules. So all the property must be financed. Finance must be owned by the 501c3 org or a governmental unit. The proceeds must be used for the activities of the 501c3 org, which and cannot be usused for any activities that are classified as unrelated trade or businesses under Section 513A of the code. And so you don't want to have, while you're allowed to have a little bit of it, you don't want to have too much. You do not want to have too much unrelated trade or business income that's generated or used for the assets that you finance with your 501c3 bonds. The 10% rule that I mentioned earlier is reduced to 5% in the case of 501c3 bonds. And typically 2% of that can be used for cost of issuance. And so that leaves you with only about 3% to finance any other private business use or unrelated trade or business that you may have going on. And we'll talk a little more about unrelated trade or business and some of the other private activities that we typically see most of the time with CHEFA's clients. And so for private activity bonds, you have to meet a test, and it's really two tests. In order for you have to sort of fail both sides of the test in order for you to have a private activity bond. So you need private business use. So typically some person who's not eligible for a tax exemption comes in and they're using the facility or the proceeds directly. So let's say a common one is you have an outside company that comes in to run your cafeteria. Well, that's a little bit different because we'll talk about that under management agreement. But let's say, for example, a lot of people have, they rent out their dorms if it's a school in the summertime to a private company so that they can house interns. and the private company pays the school for the use of those dorms. So in that case, you have the private business use, which is the use by the company to house their interns. And then secondly, you have the payment, which is the money coming in to the school. And so you have both sides of the test. And if it's too high, then you may end up having private activity. You might end up having a private activity bonds. So thanks, Dan. So typically private business use, as I mentioned, is used by used by a person or person, which can be a corporation or any sort of the legal definition of a person in their trade or business that is not a governmental unit. So we've talked about a private corporation coming in. Those could be any sort of organization, including sole proprietorships in the federal government. And then use, as I mentioned, is broadly defined. It can include ownership, it can include leasing, it can include management or service contracts, certain research arrangements, and any other arrangement that conveys a special legal entitlement for the beneficial use or priority use by the private party. So typically we see in these transactions, the facilities are not usually financed 100% by the proceeds of your bonds. Typically they're financed with a little bit of equity. There may be some taxable debt. You may have some grants, and then you may have some funds that came in through your capital campaign. One of the things, there is a concept called floating equity. And typically when you have some private business use, we try to sort of shoehorn that into your non-tax exempt proceeds. So we want to make sure that you don't sort of exceed the amount of that, let's call it non-protected money in the project with the amount of use that you're having. And so you have to measure that use very carefully. So use by a member of the general public is typically, it's your use that's available for use on the same basis as a natural person. So you'll see like a parking garage, for example, that is owned by a state or local government, financed with their bonds. But it's open to the public. Anyone can park there at any time. So it really doesn't matter if a business is having, 10 or 20 of their employees park there. So long as they're not getting any sort of entitlement or special use that's not available to everybody else. So they can't have any priority of rights. They can't have any preferences. They can't have, you can't have one rate that's just for the business, but you can have classes of rates. So you can have, like, for example, people who buy a monthly pass may pay a discounted rate versus people who come in just for the day and pay a little higher amount for a day pass. Typically, if you have arrangements in excess of 200 days, including renewal options, they're not treated as a general public use. So that's one you have to be careful of. The definition of renewal options is a little bit generous in terms of most of the rules that we tend to see from the IRS. They don't count. Typically, it has to sort of be a guaranteed renewal. If it's a first right of refusal or that sort of thing, they typically let you, they don't count that as a renewal option. So if you had something that was, 190 days with a first right of refusal, that gives you another 100 days, they wouldn't count, they wouldn't add that second 100 days into the first 190 and say you've exceeded the 200 days. So there are a couple of other exceptions to the private business use rule. One of them is the 100-day rule. And typically you want to have the term of the arrangement, including the renewals, and we just kind of talked about what a renewal option look like, shouldn't be more than 100 days. And this is an exception from the general public use requirement, because typically these are not available on the same terms to the general public as it is to this private user. The one rule that sort of follows the IRS uses throughout all of its exemptions is that you can't build a facility just for the principal purpose of providing property to the non-governmental person. So, you can't say, sports team A has their training facility next door, and I'm going to build a nice garage on my campus so that they can park here all the time. And that's really why I'm building it. It's primarily going to be used by them. We're going to enter into a bunch of short-term agreements, but it's really their parking garage. The IRS just frowns on that sort of thing. There is so the shorter the term of your use, the more generous the IRS becomes, if for want of a better word, with the terms that it allows you to have with a private user. So there is a 50-day exception as well to the general public use requirement. And so including all of your renewal terms, it should not be more than 50 days. This can be a negotiated arm's length arrangement at fair market value. And as I mentioned, the rule follows that you can't have the facility for the primary purpose of providing property to a non-governmental person. And then something that I think many of you probably use those rules when you host summer camps, or when you host sometimes the local sports teams come in for summer training and they need a place to stay. So you may have utilized the 100-day rule or the 50-day rule. Another rule that we regularly see when we're dealing with 501c3 borrowers and issuers is the qualified management contract. And this is typically most typically is your cafeteria, food services. We also see it in hospitals for somebody who's coming in to manage a particular department and that sort of thing. And you can call it different things. We typically default to calling it a management contract, but you can call it an incentive payment contract, a service contract. It sort of comes with a number of monikers. And there are different rules. For a long time, everybody referred to the 9317 rules because that was the PLR that sort of controlled what we did with private activity. And then all of a sudden we got RevProc in 2017, and we sort of 2017-13, and we kind of joked that they wanted to keep the 7 and the 13 together. So there was a RevProc that was issued in 2016, and it was revised in 2017, and sort of the inside joke, which it's only funny to us, is that they had the revision just so they could get to 2017 and to the number 13 of the RevProc. Anyway, this substantially changed, in many ways, loosened some of the rules that were under RevProc 9713. But it also kept a lot of the provisions that we were accustomed to seeing. So one of the most important ones is you can't have a share of profits. So compensation cannot be based on a share of net profits. And then it introduced some other rules, such as the burden of loss must be borne by the service provider. You can't have a prohibited relationship. So anything that would limit the issuer's ability to or the owner's ability to cancel the contract. They don't like sort of shared stock. They don't like stock ownership. They don't like shared common officers. So typically you don't want, the president of the food services company to be serving on the board of the nonprofit that is using the bonds. The 501c3 must exercise significant control over the managed property. So typically that comes in the form of you should be determining sort of the rates, and you have arrangements where people will say, well, the management company will recommend the rates that we should be setting for the use of the facility, or for what we should be charging, per plate for food, if it's a food services contract. But ultimately, the final decision should be made by the 501c3 entity and not by the management company. If there is the 501c3 entity should bear the risk of loss if there is damage or destruction to the managed property. You can, however, have your manager provide insurance for damages that would be caused by their negligence, or obviously to cover things that they would be responsible for, workman's comp, accidents, that sort of thing. And then lastly, you should not have any inconsistent tax position. So for example, you can't have the service provider saying, I'm not an owner of the facility, I don't have any ownership interest in it, but also I'm taking depreciation deductions from when I do my taxes. They should look like a manager, and they should act like a manager.
Thanks, Keisha. I'll take over on the next slide. Another way that private business use can arise is through research contracts, especially for 501c3 organizations. So a company may want to come on to your tax-exempt financed hospital or university and do a research project. And the IRS also provides for these kinds of arrangements and provides exceptions for them if you follow the proper rules. So the first exception is for a basic research arrangement. And basic research is the advancement of scientific knowledge without a commercial objective to it. For example, if you just want to survey patients' reactions to a certain drug, and I can imagine that there were, a lot of these kind of arrangements, during the pandemic, et cetera. This is just for the advancement of just knowledge in the area, rather than product testing, the efficacy of a certain drug, for example, or a curriculum on students, et cetera. So in these cases, the sponsor has to pay a competitive price for the use of any kind of patent or other product that results from the research. Doesn't have to be available to the whole world by that sponsor, but they have to actually pay for the value of what's created, whether it be a patent or some kind of other product that results. The other exception is for joint industry and government research projects. There's a lot of government funding of research, especially in the healthcare and education areas. So this is another exception to private business use of your facilities. So in this circumstance, the sponsors can fund governmentally performed research, but you have a lot of direction. The 501c3 organization has to control the research performed and how it's done. And it gets, the 501c3 is entitled to the title, to the patent, or the other product that results from this kind of research. Sponsors can get a license from the research, but it can't be exclusive to them. It has to be non-exclusive and royalty-free use of the product. There are also exceptions for federally sponsored research under the Bayh-Dole Act that do not create private business use. Another exception for private business use is incidental use. So there is a little de minimis exception under the rules for up to 2.5% of the proceeds. But this exception, you cannot transfer possession or control of any space. It can't be like a specific room in your hospital or your university that's controlled by someone. There is an exception for things like vending machines, which you typically have, or telephones or ATM machines, which can be in little alcoves, et cetera. That's okay. But otherwise, it has to be like kiosk. You know, some people will put kiosks during the summer to sell flowers or other things in their lobbies, for example. That's you know, a use that would probably fall within this incidental use exception. You know, the same user can't be have use of the hospital in another area, though, for example, because those get aggregated and you would not be entitled to the 2.5% exception. The important thing to remember about the exceptions that Keisha talked about, qualified management contracts, the short-term use facilities, this 2.5% use facilities, these exceptions only apply for private business use. They don't apply for your unrelated trade or business use. So that can trip you up. We'll cover unrelated trade or business use in a few slides. How do you measure private business use? Well, it's typically the average percentage of private business use during a measurement period. The measurement period, as you can probably understand, it starts on the day you issue the bonds. But if you have a construction period, the building isn't going to be built right away. It actually starts on the day the building is placed in service. And it ends on the date the bonds mature, they're no longer outstanding, or, which is kind of important, is when the expected economic life of the asset ends. That's important because it allows you, for example, to sell bond financed facilities or equipment after its economic life runs out without having to worry about private business use. So we'll cover dispositions a little later as well, but that's kind of important to know the economic life of your assets, and bond counsel will ask about that during the bonding process. So that's the measurement period. And it's typically, we measure private business use by square footage. Usually, you know, you're leasing or you're providing some kind of use in a certain space. So we use it, we measure it by square footage, or in certain cases by revenues. The private use revenues are a certain percentage of the total revenues of the institution. As Keisha mentioned earlier, there is this floating equity exception, which we try to document when we do the bond issue. You've put a certain amount of equity, 10% or a certain million of dollars, and we then allocate any private business use to that floating equity, so it doesn't count against you and against the bond issue. So that's an important concept. As we indicated at the beginning of the conference, is that private activity is two things. It's private business use and private security or payments on the bond issue. So not only does the person or the private user have to use your facilities, but somehow payments and security have to get through to the bondholders so that there's actual use for that, or payments for that use. You have to have both parts of the test in order to have private activity. If you don't meet one or the other test, then there's no private activity, and that kind of use is okay. So the private security or payment test is when 10% or more, 5% in the case of 501c3 organizations, of the debt service on the bonds is either secured by a bond issue, secured by property, or it's derived by payments. Now, in a typical CHEFA transaction, you may enter into a mortgage on the property, or you sign a loan agreement which pledges gross receipts, for example. So that provides security to the bondholders for the bond issue. So there's automatically private security. Some bond issuers are fortunate and they don't have to provide any security. They're just general obligation bonds, but there still is typically a loan agreement and a note that provide that you have to repay the bond issuances. And that also meets the private payment part of the test. So typically private security and payment test is automatically met because of the arrangement with the loan agreement or a mortgage. There are a few exceptions for the private security and payment test. For example, payments cannot exceed the use on slide 16. So if, for example, if somebody's using only 7% of your facility and they kind of overpay for that 7% of the facility and their payments equal 10% of the debt service on the bond issue, it gets limited to 7% under the rules. A big exception that we use and the state of Connecticut uses and some of our other municipal clients is that if you can allocate some of the private payments like rent or a fee to the operation and maintenance of the facility. So for example, if somebody wants to use your facility and you have to pay some company to come and clean up the facility afterward for the next user, then the amount associated with the operation and maintenance doesn't count as a private payment. So that gets accepted out. The other exception is that in general, if you want to give away the use of your space for free or for a nominal amount, that's generally okay. That means there's no private payment and there's typically, no security interest involved. So if you want to give away, your space for free to certain types of users, that's typically okay, at least for the private business use portion of the test. Some of the additional problems come in for 501c3 organizations is that you have to use bond proceeds within your tax exempt purpose. If you use it for things that are not within your tax exempt purpose, then that creates, again, unrelated trade or business use, which counts against that 5% or 10% allowance. And for a 501c3 organization, it's only a 5% allowance. And typically we use 2% of the proceeds for costs of issuance, which are treated as bad costs as well. And you're only left with a small 3% margin. So in most bond issues, we try to eliminate all private business use or unrelated trade or business use from the bond issue, or have it allocated to floating equity or some facility that was financed with your own equity or grants or something like that. So we try to avoid all types of private business use or unrelated trade or business use. What are some exceptions for unrelated trade or business use? There aren't very many. There's work performed without compensations. For example, volunteers. Sometimes you'll get volunteer teachers or volunteers who work around a hospital, and their use and their existence within your facilities is not treated as unrelated trade or business use. Another exception is where certain things are used for the convenience of your students or your patients or your employees, such as for colleges and universities, it's like faculty housing. You can own homes that house your faculty or your officers because they have to be on campus to do their job or close by. Same thing with employee daycare facilities. If you run a daycare facility at your hospital or at your university for the benefit of faculty or staff, then that's also treated as an exception and not treated as unrelated trade or business use. And how do we find out about unrelated trade or business use? Well, typically what bond counsel will do is they'll ask to see your Form 990s, which require you to report unrelated trade or business use on that form. And if you have unrelated trade or business income, maybe pay unrelated trade or business income tax on Form 990. And we like to, be consistent with the treatment that your tax accountants take as well. So if we see unrelated trade or business being reported on that 990 for a certain activity, then we have to be concerned about whether or not that's use of one of your tax-exempt finance facilities. So we come at this point to examples which we typically see in bond issues. And like Keisha mentioned earlier, a big one is food service. Hospitals and universities want to leave food service preparation up to experts, Aramark, some of the other ones, Chartwells, et cetera. So they'll enter into a contract with you to provide food service for a certain period of time. So we review those agreements and be sure that they comply with the qualified management contract guidelines to make sure it doesn't create private business use. Bookstores as well, you sometimes can create private business use as well. So that's another thing that we request. Keisha also mentioned summer camps. So summer camps could be a great source of income for colleges and universities during the summer when their dorms and their fields are not being used. But the IRS generally has held that sports facilities or sports camps are not within the exempt purpose of a university. Your purpose is education. It's not to provide sports. Even though everyone has made arguments, and there's been lots of private letter rulings on this issue, that physical activity is all part of educating the young mind, et cetera, and that you'd have sports teams during the academic year. A sports camp is just not considered part of your tax-exempt purpose of providing education. If it's just for your own sports teams, for example, running a summer practice for the football team or the soccer team with your coaches, that's fine. And it even might be fine if you brought in a third party to do that for your own students, et cetera, as long as you qualify for one of the short-term uses, that's okay. But in general, hiring a third party and having them come on campus and running a sports camp, football, soccer, et cetera, lacrosse, those contracts need to be carefully reviewed. Again, you might be able to still have them because the use is de minimis. It's very small compared to the use by the school, but or it also could involve facilities that are not tax exempt financed, like the older dorm, et cetera. But you have to be careful about use of your fields and your dormitories for sports camps. Academic camps, on the other hand, are perfectly fine. If you want to have rent your facilities for SAT preparation or summer school or theater usually is fine as well, or lectures, things related to education are perfectly fine because they're within your educational purpose. And whether they're run by your own people or they're run by a third party and comply with one of the short-term use exceptions, an educational use of your facilities during the summer is okay. Another thing sometimes we see are what are called naming rights. Now for 501c3 organizations, that usually involves, a big donor coming in and maybe they want to, put their name on your building in exchange for $5 million or $10 million or something like that. Those types of arrangements are usually fine because there's a donative intent. And those contracts don't usually come with a lot of strings attached. But for example, if for all sports facilities, Duncan Park in my background here, or City Field, when those companies want to put their name on a facility, then they want their name to be mentioned every time the field is mentioned. They want to be able to put advertising within the facility. They want their name on cups and napkins, and they have very specific contractual rights within that facility. That's where naming rights become an issue for tax-exempt financing. And there's an IRS ruling from 2003 that kind of covers this specific example. And again, it can be done. The IRS says, you know, it's not really the 4 bricks where you attach the sign to the building. That's not the proper measurement of the private business use. It's really measuring the contract value versus the value of the facility. That's more the proper measurement of the private business use created by a naming rights contracts. Other examples we run into are doctors' offices where they see patients that are not at the hospital, for example. You know, we typically don't allow tax-exempt financing of doctors' offices. A pharmacy, for example, that lets outside patients or outside members of the general public come in and use their pharmacy in the hospital. We typically measure that again by revenue. So if you have general public pharmacy revenues, we measure that as bad against revenues from the pharmacy from people that are within the hospital, have been patients within the hospital. Even a parking facility that you put up next to your hospital or your university can have private business use because you're letting the general public use it. Your tax-exempt purpose is not providing parking. It's for education or for healthcare. So the IRS would treat a member of the general public who comes in and pays to use your parking facility as private business use. Again, if you give it away for free and let them park there for free on weekends or something like that, that's perfectly fine because there's no payments involved. But again, you have to always consider whether or not use of your facilities is within your tax-exempt purpose. Many of you may be aware that certain investment income, entering into limited partnerships or things like that, can create unrelated trade or business income. But that's not the kind of unrelated trade or business income we're really concerned with, because those limited partnerships don't come onto your facility and use your, use your rooms or your equipment. That's a kind of a different area which you should discuss with your tax accountants. So what happens if you actually happen to have some private business use, or you have an empty facility and you really need the revenue to pay off your bond issue or pay some costs, and you would like to lease it out or even sell it to a third party who's offering you an income stream or a big payment in exchange for it? Well, the IRS regulations provide for dispositions, and there's remedial actions that allow you to keep your tax-exempt bonds outstanding, but use it for, but you have to follow certain rules to remediate it. And in general, if you take the money and you use it to pay off bonds, a certain amount of the bonds, that's okay. Or you take the money from the sale of the tax-exempt finance facility and invest it in another tax-exempt facility, that's probably okay as well. But there are many rules that we have to look at to do that, but the IRS does provide for that. And the important thing to remember at the beginning of these transactions is that borrower's counsel typically gives an opinion that the use of the tax-exempt proceeds will be within your 501c3 exempt purpose. It's kind of up to you after the bond issue to make sure that it continues to be done that way. At that point, I'll turn it over to Dan for arbitrage.
Thanks, Dave. So we'll take this opportunity to discuss arbitrage compliance. It really has been something that has really been an issue for the past decade, and we'll look at how investment yields have really impacted that. And we'll try to go through the refresher of kind of what it means to be compliant of these arbitrage rebate and yield restriction rules and what you can do to avoid making these payments. The first thing, so what is arbitrage? Arbitrage refers to the investing of tax-exempt proceeds at a different taxable rate without incurring additional risks. So for example, borrowing 3% and investing those proceeds from at 4% creates that positive arbitrage. What the IRS and the US Treasury want to avoid is for investors to profit from the disparity between markets. The IRS views the tax-exempt bonds as lost tax revenue. And so they've created regulations to minimize this revenue, focusing on three key things. They don't want borrowers to issue more than what they need. So they want the bond issuances to be for the project needs or to whatever refund or refinance the prior debt. The other issue, they don't want you to issue too early, and they don't want to keep bonds outstanding longer than you need to. And part of that is also spend the proceeds timely. They don't want borrowers to issue, hold that funds, benefit from the high yield investment returns, and then use it to reimburse for project costs. So all these regulations are based off of incentivizing borrowers to address these three key things. So there's two main regulations related to the investment of tax-exempt proceeds: arbitrage rebate and yield restriction. The regulations do overlap and borrowers must adhere to both of them. Arbitrage rebate, it does not limit the investment yield, but requires borrowers to pay back to the IRS any earnings above the bond yield. Whereas yield restriction restricts the investment yield. So borrowers must make sure that they earn below that limit or make a yield reduction payment to lower their investment yield below the bond yield. And to determine whether you have where you meet with these regulations, the IRS requires that calculations are performed at least every 5 years and at the final redemption. And at that time, it is if a liability is determined, you must make a payment to the IRS. Kind of look at the historical trends and really why arbitrage rebate is a concern right now. Since 2013 and actually even further back, investment yields have been near zero on the short-term treasury yields, and that's where a lot of the bond proceeds are being invested into. So there wasn't a lot of opportunity to earn a positive arbitrage. As I reference here, and you'll see through the next couple slides, is the 30-year MMD AAA yield. The MMD is the municipal market data. It's a benchmark for municipal bonds that provides the offer side yields. It is published by the Municipal Market Monitor from Infinitive. And it really kind of sets a base mark and compare, and we can kind of track to see if there is a positive arbitrage or a negative arbitrage environment. As you can see here, the difference between those, there really wasn't a lot of opportunity for arbitrage rebate until July 22. So let's kind of see where we are these past couple of years. So in January 2013, the short-term yields were at near 0%. And the 30-year MMD AAA rated was 3.24%. And so that spread was a significant negative arbitrage rate period. And then as the years went by, in 2019, we saw treasuries spike up to 2.45, but there still was the negative arbitrage. So really, borrowers were never really investing their sale proceeds above that bond yield. It wasn't until July 22, and this is when arbitrage has now become a concern for borrowers and something they need to be focused on. Now in July, the 30-year MMD AAA rated is 2.89, and the 3-month treasury was 2.96. So anything beyond that now is what is subject to rebate and yield restriction. And I'll show kind of how that applies to a recent bond issuance. So let's say you issued on January 1, 2020, at that time, the MMD yield was 1.8%. at issuance, the treasury yields are coming down from their high in 2019, but they're falling back to zero, near 0%. So we were during the project phase, or when you're building your project and having all these bond proceeds invested, you really were producing a lot of negative arbitrage rebate. There wasn't even a worry that you were going to exceed the bond yield and have to make a rebate payment. But as the project went along, and as we went along, rates started to rise in 22. And the one rule that borrowers need to be realized is yield restriction. After a 3-year period, and we'll talk a little bit more about this, the temporary period ends, and any proceeds in the construction fund become yield restricted at the bond yield. So at that time, for this example, in January 1, 2023, the 3-month treasury is yielding 4.69%. There's an excess investment yield of 2.89%, and that's going to be subject to yield reduction payments to the IRS. And so that borrower needs to be concerned about that. They either should have tried to get the project finished before then, or are going to realize they're going to have to make a yield reduction payments as they spend down the remaining project proceeds. Now, for new borrowers who are coming to the market, who just came to the market in 22 or are coming to the market shortly, they don't be afraid of arbitrage rebate, but you want to manage it. The main ways to avoid it and manage it is to meet the spending exceptions, which we'll discuss, and keeping your projects on time and finishing them before the temporary periods. And that's going to be the one way to minimize significant rebate and yield reduction liabilities. So, arbitrage compliance. So, as I said, a borrower, to avoid it or manage it, they can use the spending tests, or they can make sure they spend the proceeds before the temporary periods. So, if they do fail to meet those tests, earnings on the gross proceeds in excess of the yield is going to be subject to arbitrage rebate payment. To calculate that, we're going to perform those calculations every 5th anniversary of the issuance. And if the investment yield is greater than the bond yield, that payment would be due to the IRS. What is due is dependent on what the type of calculation. If it is one of the first anniversary 5-year calculations, they have the opportunity to pay 90% of the liability within 60 days of that calculation date. But if it's the final calculation or final maturity or redemption, there's a payment requirement of 100%. And for most of our borrowers, CHEFA does perform these calculations. We will do these on your behalf, and will inform the borrowers if the payment needs to be made and when it needs to be made by. So, like we said, gross proceeds is what's subject to arbitrage rebate. But what is gross proceeds? It's these 4 key things. It's the sale proceeds, the proceeds received from the transaction, the investment proceeds that from those invested sale proceeds. We did have transfer proceeds. It's really not a big thing nowadays, now with the elimination of advance refunding, but it does exist in some cases, and also replacement proceeds. So you'll typically see the accounts that the language that we see is your construction funds, your debt service reserve funds, escrow accounts. Those are all the accounts that are going to be subject to the arbitrage rebate, in addition to debt service funds and any pledge funds that secures the bonds. So to manage those rebate and to manage the gross proceeds that are subject to arbitrage rebate, there's spending exceptions. So the construction fund proceeds can become exempt from rebate if they meet the requirements of one of the spending exception schedules. There's 3 schedules: the 6-month, the 18-month, and the most common one is the 2-year exception for construction issues. Each of these tests have benchmarks that must be met for those proceeds to be exempt. You can't, if it's the 18th month, you can't fail to meet the 6-month benchmark and then make the 12th and 18th month and assume that you're exempt. You have to meet all the requirements of each exception. In addition, on top of the construction from proceeds, what's included that is investment income. So when we look at, and we have an example later on, if you have $10 million in your construction fund and you're trying to follow the 2-year exception, you need to spend the $10 million plus any investment income to meet that 100% benchmark. And if you do so, those funds would not be subject to rebate. I do kind of want to remind people, reserve funds, if you have a debt service reserve fund, those do not count and will not be exempt for rebate. They will still be subject to the arbitrage regulations. And so when we look at these schedules, we try to determine how proceeds are spent and the timing of the spend. CHEFA, for us, we typically treat the date the bond proceeds are distributed from the construction fund as the date the proceeds are spent to determine compliance. That's the easiest test for us. We have the backup for that. And in most cases that works. Now, if there's issues, obviously, now that we're in a positive arbitrage rebate, the spending exceptions are going to be critical for those to avoid those rebate payments. We can use the actual dates, the eligible invoices were paid to determine compliance. And though we do have some borrowers with drawdown bonds, the spending exceptions typically do not apply to those bond issues because the proceeds are typically spent the day they're drawn down. And so they wouldn't be subject to those requirements. So like I said, the most common schedule is the 2-year exception, and that the construction. Most of our bond issues that have a new money or project portion are going to be eligible for this, and this is what you need to try to meet to avoid or manage your arbitrage rebate requirements. So a construction issue is where 75% of the available construction proceeds will be used for construction expenditures. And construction expenditures is just brick and mortar. It doesn't include land acquisition or equipment. It's only the brick and mortar to build those facilities. And when we say available construction proceeds, it really is the bond proceeds as well as those earnings on those bond proceeds. But it does not include your cost of issuance and your reserve funds. And I do want to note that in some cases, borrowers issue bonds that would have multi-purposes. You have a refunding or a refinancing portion and a new money portion for your projects. We can bifurcate those issues and separate it, so allow you to meet the new money portion can meet those spending exception purposes and be treated as a construction issue. So like I said, here's an example. We have a $10 million bond issue that was issued on June 1st, 2023. We can look at the sources and uses of these proceeds. It's a $10 million bond, $200,000 goes to the cost of issuance, $9 million to a construction fund, and $800,000 to a debt service reserve fund. We anticipate there'd be $100,000 in earnings over the construction period. And so we come up with an estimated available construction proceeds of $9.1 million. And we use that as part of to determine our spending exception requirements. So you can see in this table here, kind of the minimum spending requirements. This borrower needs to meet all of these 4 benchmarks to have these proceeds, the available construction proceeds, to be exempt from rebate. And like I said, on the final benchmark, it's not the $9.1 million. It's actually going to be actual earnings. So that could be more or less than what was estimated. So if the borrower meets all of these spending exceptions, then the $9.1 million would be exempt for rebate. If the cost of issuance proceeds are spent within 6 months, they are also exempt for rebate. In this case, only the $800,000 that went into the debt service reserve fund would be subject to the rebate requirements. And as a reminder, spending exception is not mandatory. It's just an incentive the IRS has established for those 3 points to incentivize borrowers to spend their proceeds quickly, to use those proceeds up and quickly move on to the project. So the arbitrage rebate calculations are a little complicated, but I think it would be an opportunity to present what are they and what are the steps, and kind of give you a perspective on what we need and when we're seeking stuff for that and how it would impact your liabilities. So there's 3 main process steps for the calculations. The first is calculate the bond yield. You have your fixed rate bond issuances, and that yield is calculated at the issuance and can be typically found on your 8038, that form that's submitted to the IRS. Variable rate yields are calculated every computation period. Just for clarification, for some bond issuance that are fixed for a period of time through a tender date, those are for tax purposes treated as variable rate. So we'll have to estimate those every computation period. And with those variable rates, we will also need to include information like qualified guaranteed and integrated swaps. So if the borrower has a bond insurance or a letter of credit or an integrated swap, they need to be prepared to submit that information to CHEFA or your arbitrage rebate specialist, so they are able to determine what the variable rate yield is for that computation period. The next step is determining the gross proceeds of the bonds, understanding the investment earning on those proceeds, and trying to allocate if it's complex and there's multiple issues, and that's the most complex step. And from there, we can be able to determine what the calculated rebate amount is. And what that really comes down to, it is the excess of the future value of all receipts from investments minus the future value of payments for investments, determined by using that bond yield that we calculated in step 1. And we just use a simple future value formula. So this is kind of how that rebate calculation looks. In this we had a bond issue with a first computation date of April 1st, 2003. We calculated a bond yield of 5.065%. And then we determined what the gross proceeds were and all the investments associated with that. So total receipts was 5.1 million and total payments is 4.5. So using the future value formulas and the bond yield, we're able to determine what the rebate amount is, and that's $59,715. Since this is the first computation date, the borrower is only required to pay 90% of that, which is $53,743. So the next regulation, the other regulation, is yield restriction. And like I said, yield restriction differs from arbitrage rebate because it really restricts on how much you're able to earn. You're not there's certain funds have a period where they can earn whatever they want, even though they're still subject to arbitrage rebate. But after that period, they're held to a yield restriction. For the most common one is your construction fund, and that has a 3-year period. So the goal for most of our borrowers should try to spend the proceeds before the end of that 3-year period, especially in a rate environment right now, because once you're beyond that period, now you're in an area where investment yields are significantly higher than the bond yields. The other ones you need to worry about are your cost of issuance and your debt service reserve fund. The debt service reserve funds have a temporary period for the life of the bond unless they exceed the reasonably required amount. And that's a calculation of the lesser of 10% of the original principal amount, or the maximum annual debt service, or the 125% of annual debt service. So once we go beyond, if there's proceeds beyond those temporary periods, what does that mean that they're yield restricted? For our construction funds, they may not be invested more than 1/8 of 1 percentage point above the bond yield. For the debt service reserve funds, debt service funds, replacement proceeds, they may not be invested above 1/1000th of a percentage point above the bond yield. Now, borrowers have the ability to either restrict their investments at that rate, or they can make yield reduction payments to comply with the yield restriction requirements. And typically for a construction fund, that's what you're going to do. You're not going to yield restrict at that, but what we would make a yield reduction payment to lower the investment yield to that materially higher amount than the bond yield. So, and these payments are similar to the rebate payments that we make with the computation dates. They're made at the same time. The only difference is that they are there's no exception to pay 90%. The borrowers must pay 100% of the yield reduction liability. So what does this look like in yield restriction? And so in this example, we look at a bond issuance dated January 1, 2020. They went through the project period with a lot of negative arbitrage. They were able to offset some of the positive arbitrage at the end of the 3-year period with that, but they still have $3 million left in the construction fund at the end of the temporary period, or January 1st, 2023. Those proceeds are now yield restricted at 1.925%. But our short-term treasury yields are averaging 4.94%. So the borrower, to get to that 1.925%, the borrower will need to make a yield reduction payment to reduce that investment yield. And the cost to lower the yields in this estimate would be about $7,500 a month. But that liability can be paid with the remaining proceeds in the construction fund. So if you have questions regarding arbitrage rebate and yield restriction requirements and regulations, where can you go? The first source, the source I wouldn't recommend because the most complicated source would be the Section 148 of the Internal Revenue Code. And that's where the IRS has laid out all their regulations. But a good source to go to first, and it's that big binder that's going to be on your debt, it should be on all your desks, is in the bond document, is the tax certificate or the tax regulatory agreement and the Form 8038. These two documents are going to be helpful, not only with arbitrage rebate and yield restriction regulations, but also help you with your Schedule K in your Form 990. A lot of that information will be able to help and try and help you there. And then finally, you can ask us. We're here to help. You can contact myself or Michael Morris, and we can kind of address any questions you have regarding arbitrage rebate and go from there. So okay. So we are now done with the arbitrage rebate section, and I'd like to turn it back over to Dave to kind of give us a background on post-issuance compliance.
Thanks, Dan. And we're running short of time, so I'm just going to cover this very quickly. But when you do your bond issue, all the lawyers and CHEFA make sure that you're complying with all the rules at the time of the bond issuance. But bonds last for 20, 30 years sometimes, and the rules apply for that entire length of the bond issue. So you have to continue to comply with all these rules for 30 years in some cases. So the IRS, believes that the best way to ensure compliance, and most, tax rules are self-complied with. We all try to be honest about our taxes, and the same rule kind of applies for tax-exempt bond issues. It's all about self-compliance. So the IRS believes that if you develop written procedures about complying with the tax rules, that's the best way to ensure compliance with the tax code. And the IRS does audit in this area. Keisha and I have both done, dozens of audits. The IRS sometimes audits private activity questions. They sometimes, especially during years of high interest rates, they'll audit bond issues for arbitrage purposes and rebate purposes. They audit, to make sure your bond proceeds are used for a 501c3 tax exempt purpose, but they audit this area fairly often. And in addition, you're required to fill out Schedule K on your Form 990 every year. And it asks lots of questions about your outstanding bonds, whether, there are management contracts, private business use, whether you've had arbitrage rebate calculations done. So somebody signs that tax return every year. So you have to make sure that you're in compliance. Again, the institution is ultimately responsible for monitoring all of the tax requirements, but generally, you're the ones in control of your property, of the private business use of your property. CHEFA does a really great job of arbitrage, meeting the arbitrage requirements, and Dan monitors, rebate payments if they're due and yield reduction payments if they're due. We have a list here of what's in your written procedures. And Robinson and Cole, has a draft written procedure document that you can complete. And that way, next time you do a bond issue, you can check the box that you have written procedures for tax-exempt bonds outstanding. And CHEFA has their own policies as well. But in general, throughout the rest of the slides here, the borrowers have certain jobs to do, including Schedule K, final allocations, making sure the money is used in compliance with the tax rules. And then CHEFA also has their role as well, doing the bond rebate calculations, yield reduction payments. And I think at this point, we can, turn it over for any questions that might be out there in the audience.
So David, if I may, before we take questions, the one thing that I would say borrowers should always remember is that when you are dealing with tax-exempt bonds, your records are really important. And really, you should be maintaining your records sort of for the life of your bond. Some people have short record retention policies where you might destroy your records after just a couple of years. Your bond documents and any documents related to your bond, such as your investment income and that sort of thing, should be an exception to those document destruction policies.
Yeah, and I would add, Keisha, too, and one of the things that we've learned with that record retention, it's not just the life of the bonds. It's the IRS requires 6 years after the life of the bond. That also includes refunding. So if you issued a 30-year bond, refunded that bond deal, now the record retention that was with the original bond deal now follows that new bond deal. So you're going to have to keep your documents for a long time for all these refundings.
That's correct, Dan. And sometimes putting that into your written procedures, one, it reminds you that you need to do it, but that might actually be the basis for you to talk to your IT people about why they can't just delete the documents.
Yes. Or why you need a larger storage room.
That too.
A question is asked, this deck will be available on CHEFA website after the webinar. Anyone else have any questions? Another example that we're seeing more and more of is, energy generation on campuses. People come and want to put a solar panel on top of your building, or they want to do some kind of cogen project. Again, those are contracts or arrangements that can create private business use or unrelated trade or business use. If the energy is solely for your own use, those are probably perfectly fine. But a lot of the arrangements also involve selling energy back to the grid, and you get revenue from that. So in those cases, we may have to do some measurements of the potential private business use. So if those arrangements come up, please, let CHEFA or your attorneys know.
And I'd say sort of a best practice would be, if in doubt, call your bond counsel and ask the question, what does entering into this contract mean for my outstanding bonds?
Okay, is there any more questions? Oh, here we go. I do have a question here. Where can borrowers learn more about mixed use and private research with instruction connections in a bond finance facility?
There is a specific regulation on mixed use. Unfortunately, in general, if you have both exempt use and private business use of at the same time, it's considered private business use. But there are also rules that allow you to separate the two uses. And for example, using revenues generated instead of square footage measurements. The pharmacy example is a good example of that we've used before. So again, there are regulations that address this a little bit. Sometimes, bond counsel has to, think about how the regulations apply to your specific situation. There might be a private letter ruling on specific types of arrangements. Unfortunately, there's, not a lot of IRS rulings in the area of tax-exempt bond proceeds because it's not heavily litigated. So we don't have a lot of guidance out there, but there is some. So again, if you have a specific situation, let CHEFA know. They may have seen it previously and they could advise you. Otherwise, what they'll do is they'll contact your bond counsel and talk about it. You're welcome.
I have a quick question, Kim Nahili, on the private business use for management agreements in the hospital setting. And is it correct that the physician agreements, on call type arrangements, medical director agreements, exclusive clinical services agreements are within the definition then of management agreements and service agreements that could give rise to private business use and otherwise don't meet the exception of being incidental to the exempt organization's purpose, meaning they'd have to satisfy the 2017-13 safe harbor?
Yeah, it kind of depends on the arrangement. Usually, like your contract with your chief of surgery or your chief of certain specialties, those are like more like employment agreements. So those would not, give rise to private business use and wouldn't need to comply with the management contract guidelines. But for example, if you hired a partnership out there of doctors to run a specific practice area, and you hired specific docs from that practice, that contract would probably need to comply with the qualified management contract guidelines. And again, the object here is that, your facility has been financed with tax-exempt bonds, favored bonds, and they don't want to give, a private company use of a tax-exempt facility that they can run their own private little business in. That facility has benefited from tax-exempt bonds. The rent value is lower. Things are generally tax benefited there. So they don't want to confer that benefit to another company. But if the person is more of your own employee, then that's probably not subject to the rules.
Mm-hmm. I mean, clearly, if they were seeing private practice patients, that would be an issue. But to the extent that they're providing, a physician group is providing the exclusive clinical for hospital-based services, radiology, anesthesia, those types of services, it would just need to be 2017-13 compliant, I think is what I'm hearing you say. Because they're not a W-2, right? They're a 1099. Okay, thank you.
Right.
Any other questions at all? No, I think that's it. Michael?
All righty. No, I just want to thank everybody for attending today, and special thanks to Keisha, Dan, and Dave for the very informative presentation. As David mentioned, the slide deck will be on our website as well as the recording of this presentation. And we can't stress enough that if you do have a question, please do not hesitate to contact us or your counsel. So that's about it. And thanks again for attending, and have a good afternoon.